Everybody's putting their money in CDs. What is a one-year CD paying? Under 1% unless you get a special deal and you get a point, a fraction. So you're buying 1-year, 5-year, 3-year CDs. Everybody's talking about their CDs. They're not even giving out toasters anymore. It's ridiculous. So there's another investment, billions of dollars in. Then you come to the good part that Wall Street likes the best. Their managed money in their mutual funds. Stellar performers last year. Down about 35% each. What do investors like? Well, there may be an upside. What don't investors like about it? More volatility, big downside. They're scared of it. It's totally intangible. At least real estate's there. This stuff's amorphous. It disappears overnight. Well, what other products do they have there? They've got hedge funds. Hedge funds are bleeding money. Bleeding money. Bernie Madoff did a job on them, and the other hedge funds have underperformed in the last year, and they're losing money. But the smart hedge funds are doing what right now? They're buying real estate and real estate syndications within these hedge funds. So the smart money is already gathering real estate in the hedge funds. You don't hear too much about it, but that's happening right this second. Annuities. A very big seller on Wall Street. This is a competitive product. And this could be a lecture of 8 hours. 3 different types. There's fixed annuities. That's like getting a note from a bank. The brokers sometimes call them CDs. They're certainly not CDs because they're not government backed. They're backed by the insurance company. And they come out 1 year, 3 year, 5 year, up to 10 year. Second type is index annuities. Now these are very safe. Wall Street is selling safety to everybody. That's why they're selling CDs, money market, tax-free bonds. Safe. What's the problem? Well, there's very little upside in an index annuity, and it has more moving parts than a Swiss watch. They've got, if you understand this, caps, point-to-point, spread, and the 5 different indices that these things work against. But the fault on this product is, and again, I'm showing you the fault of these products, is that it charges about 3 to 3.5% per year on the investment. Well, 10 years, 3 to 3.5% is how much?
35%.
It's a nice load. That's what happens, but you're buying guarantees. So for some money, it's not a bad investment. And probably one of the biggest sellers right now is tax-free bonds, municipal bonds. These are paying between 4 and 5%, but you're going out how long? 20 years, 30 years to get that type of yield. If you buy a short-term bond, you get basically no yield. You're barely keeping up with inflation. What is the problem with going out 15, 20, 30 years? Interest rate risk is tremendous. 1 point, just 1 point on a 30-year bond will diminish that bond's value by 8%. 2 points, close to 16. It's a little curve there, it's a little complicated. But you can see that if the government raises the interest rates a bit and inflation picks up, and I don't see a reason why this will not happen in the next 4 to 5 years, with the government borrowing trillions of dollars and printing it, then these people will be well underwater. So they may be secure today, but the security will be fleeting if we have an inflation. Just think, what if one of our benefactors, I call them benefactors, Russia, China, Japan, says, we don't want to buy any more of your paper on the open market. What do you think would happen to interest rates in 5 seconds? I'm afraid to ask. Well, that's the product, the things that Wall Street's selling today. Look how real estate beats that. You can beat the yield. Oh, by the way, the yield on what, a 10-year treasury, what do you think it is? 2 and a fraction, almost 3%. Is that a return for anybody? Is that a return you can live on that's taxable? How do you beat inflation with that? There's government bonds. So your real estate programs now and the syndication deals will be better than the products that they're selling. That's why Wall Street needs new products.